Are you actively exploring opportunities to acquire your first e-commerce business? Or maybe you're looking to level up your portfolio. By the end of this video, you'll uncover untold secrets and industry-specific tactics that will completely shift how you approach acquisitions. From finding hidden gems below market value to conducting bulletproof due diligence that gives you negotiation leverage. We're diving deep into expert-level strategies that most buyers never hear about. Whether you're here to secure a steady cash-flowing business or to bet on a fast-growing trend, this guide will not only educate you, but also show how to avoid costly mistakes and ultimately acquire them with confidence. So let's dive right in. The foundation of any acquisition should start with defining your goal. Before we get into sourcing deals or running due diligence, it's crucial to clarify your acquisition goals. These goals dictate everything from the type of business you pursue to how much you're willing to invest. There are typically two paths: the stability path, conventional acquisition path. If your goal is steady performance in terms of revenue and profit, look for businesses with consistent earnings over the past 3 to 5 years minimum. These tend to have lower risk, established customer bases, customer acquisition strategies fully optimized, and operational systems already in place. Think of brands selling evergreen products like health supplements or baby products. These are resilient niches that perform regardless of seasonality or trends. This Gainbox brand is a perfect example here. It's been operational for over 11 years, had a stable $549,529 annual revenue, and a decent 40% margin every year. The marketing, return customer rate, and operation have all been successfully systemized, and it makes it a decent acquisition target, all things being equal. The flip side of this conventional approach is the trend-driven path. This approach is higher risk, but potentially higher reward. You're looking for a business riding a trend, perhaps a new fitness gadget, or a trendy supplement that exploded during the New Year's resolution season, or a viral TikTok product. These businesses often have explosive revenue growth in a short period, less than a year. The upside, scalability. The downside, trends fade. The audience may get bored once the trend is over, and marketing and operations may not be optimized. Here's a live example. This brand, Fun Punch, sells a viral mini punching bag and generated close to $1 million in the last 12 months. 80% of its revenue comes from viral content online and has a lot of potential to leverage paid ads to scale further. You see the challenge here. It had a spoke in revenue in December 2023 for £250,000, but has been experiencing a decline since then. While this might appear risky to a conventional investor, it also presents a lot of opportunities to a more risk-tolerant investor. But the best path of all is the hybrid approach that combines both approaches. But what if you want a bit of both? A hybrid strategy targets businesses with an upward revenue trajectory, but also foundational elements like repeat customers, explosive growth, streamlined marketing strategies, or an engaged email list. These businesses balance risk and reward, making them excellent mid-tier acquisitions. Having this clarity up front saves time and energy and sets you up for success. Sourcing deals. So, where do you find deals? Once you know your goal, the next step is sourcing deals. Let's start with the usual suspects. Flipper, best for smaller e-commerce businesses and startups. It's perfect for first-time buyers, but be cautious. Some listings are pump and dump stores with inflated metrics. Look for businesses with at least 12 months of performance data. Empire Flippers. This platform vets businesses more thoroughly, so you're less likely to encounter red flags. However, competition is high, and listings often sell quickly, so be prepared to act fast. Brokers. Working with a broker can streamline your search. They curate businesses based on your criteria, but their fees can eat into your budget, so make sure the broker has a solid reputation and specializes in e-commerce. FE International focuses on larger, more established e-commerce businesses with a strong vetting process. Acquire.com, best for smaller SaaS and e-commerce businesses with a focus on direct deals. Website Closers specializes in larger e-commerce businesses and Amazon FBA brands. Business Exits, premium brokerage focusing on an e-commerce and tech business. Biz Buy Sell, general business marketplace, but it includes e-commerce businesses. Alternative ways to find e-commerce businesses include LinkedIn and Facebook groups. Join groups like e-commerce entrepreneurs and Shopify Exchange to find off-market deals. Reddit, r/entrepreneur, r/flipper, r/startups. Some business owners post opportunities here. Direct outreach. If you have a niche in mind, reach out to business owners directly to see if they're interested in selling. Beyond these platforms, consider off-market opportunities. Subscribing to Flipper's premium service can give you access to deals before they're even publicly listed. You can also build relationships with many sellers directly through LinkedIn or industry forums. Many great deals never hit the public market, and reaching out to sellers directly can be a goldmine. Red flags. Avoiding pump and dump stores. Now, let's talk about what to avoid. Unfortunately, not every e-commerce listing is a gem. Many sellers inflate their revenue or sell unsustainable businesses. So watch out for heavy ad dependence. If 90% of traffic comes from ads, ask yourself, what happens if ad costs rise? Dropshipping models. While not inherently bad, dropshipping stores with bad customer reviews, non-branded customer experience, long shipping times, and low margins often struggle to retain customers long term. Revenue spikes. If a business has 1 or 2 months of unusually high revenue, dig deeper. Was it due to a seasonal trend, a few viral videos, or a one-off marketing campaign? The key is to prioritize businesses with diversified traffic sources, repeat customers, and strong operational systems. Remember, a flashy revenue chart means nothing without a solid foundation. Due diligence. Protecting your investment. This is where most first-time buyers fall short. Due diligence. It's not just about verifying revenue, it's about understanding the business inside out. Here's what you need to check. Financials. Verify profit margins, ad spend, customer acquisition cost, and operational costs. Look for consistent growth, not just sudden spikes. Traffic sources. Access their Google Analytics, check their Shopify dashboard, and even review all the marketing platform backends. Where is the traffic coming from? Organic traffic is a huge plus. Supplier relationships. Are the suppliers reliable? Do you have contracts in place? Customer reviews. Look for red flags in product quality, customer service, and shipping delays. The beauty of thorough due diligence is that it doesn't just protect you, it gives you leverage during negotiations. For example, if you discover a weak supply chain, poor online rating with a customer review on TikTok or Trustpilot, or even overestimated profitability, you can use that to negotiate a lower price. Thorough due diligence equals better negotiation leverage. Negotiation strategies. Closing the deal on your terms. Negotiation is both an art and a science. Here are 3 tactics to help you secure a better deal. Highlight weaknesses. Use what you've uncovered during due diligence to justify a much lower offer. Stay patient, don't rush. Sellers often lower their price after a listing sits on the market for a while. Consider earnouts. Instead of paying the full price up front, negotiate to pay part of it based on future performance. This reduces your risk. Earnouts protect you from overpaying. Transition and scaling, setting the stage for success. Acquiring the business is just the beginning. Transitioning and scaling are where the real work begins. If the business doesn't come with a team, you'll need to quickly hire or outsource key roles like customer support, operation, and marketing. If it does come with a team, focus on building trust and ensuring a smooth handover. Scaling is all about optimization. Start with low-hanging fruit like improving ad performance, figuring out strategies to reduce operational cost, or increasing email marketing ROI. At trendhijacking.com, we specialize in spotting acquisition targets, conducting due diligence, and expert negotiation, acquiring and even managing the operation and marketing of your business on your behalf. We spot, acquire, and reposition brands, launch aggressive marketing campaigns, and optimize operations for maximum growth for the sole purpose of an exit. So, planning your exit, the end game. Finally, always plan your exit from the start. The longer a business operates profitably, the higher the multiple you can sell it for. For example, one of our recent acquisitions generated $1.7 million in revenue in under a year, with a 19% profit margin, and sold for $367,000. By focusing on consistent growth and building brand equity, you can create a highly valuable asset that appeals to future buyers. Acquiring an e-commerce business can be life-changing, but only if you approach it with the right knowledge and strategy. At Trend Hijacking, we help individuals like you find, acquire, and scale e-commerce businesses, handling the complexities while you reap the rewards. If you're ready to leverage an expert team to automate your entire acquisition journey, visit us at trendhijacking.com. We're hoping to make more education videos just like this. So please like, subscribe, comment below with your questions. We want YouTube to push our video out to more acquisition entrepreneurs like you. We'll see you in the next video.